Now let's cover discarding fixed assets. So if a fixed asset is no longer used and has no residual value, it's going to be discarded. Other way, we just throw it away. So the discarded asset and its accumulated depreciation are removed from the accounts and ledger. So remember, we have two accounts that are connected to each other. The fixed asset account, which let's say an equipment, and its related accumulated depreciation account, which is for that equipment. So both of these accounts, they need to get removed from the ledger. So let's see this example. Assume that equipment acquired at a cost of $25,000 is fully depreciated. So on February 14th, the equipment is discarded. The entry to record the discard would be as follows. So we record the date, which is February 14th, and then remember, equipment has a debit nature. We want to remove it from our books, so we're going to record it on the side opposite to its nature. So it's going to be on the credit side. Same thing for the accumulated depreciation. Accumulated depreciation is a contra asset account. It has a credit nature. We want to remove it from the books. So in this case, we're just going to debit the accumulated depreciation for the equipment based on the value that's already in the account. So in this case, it's 25,000 and 25,000, and that way we were able to write off the equipment that got discarded. So if an asset has not been fully depreciated, and that's another common scenario, we have an asset that we decide to discard before it's fully depreciated. Depreciation should be recorded before removing the asset from the accounting records. So we have to adjust for the depreciation first, and then we remove the accounts. So let's see this example again. Assume that equipment costing $6,000 with no estimated residual value is depreciated at a straight line rate of 10%. So again, if we want to convert this 10% into years, we can just take 100% divided by 10%, and you can guess that this is 10 years. So the expected life of that equipment was 10 years. The accumulated depreciation balance after adjusting entries is $46.50 on December 31st. On March 24th of the following year, the asset is removed from service and discarded. The entry to record the depreciation for the 3 months before the asset is discarded would be as follows. So please pay attention to that. The asset has been used for a specific period of time. It has an accumulated depreciation balance of $4,650. Yet we discarded it on March 24th. So we used it for another 3 months, almost 3 months. So since it's March 24th, we just rounded up and assuming that it's March 31st. So we're going to calculate depreciation only for 3 months. So what was the original cost of the equipment? It was $6,000. We multiplied by 10%, which is the straight line rate of depreciation, multiplied by 3 over 12, and that would be $150. So we're going to do a regular depreciation expense adjusting entry, yet it's going to be a little bit sooner than the end of year. We're doing this adjusting entry before we sell or discard this equipment, so we want to update the depreciation expense and the accumulated depreciation before end of year. So we go on March 24th, we debit depreciation expense, and we credit the accumulated depreciation for equipment for $150. Again, how did we get the $150? It's the $6,000 multiplied by the 10% multiplied by 3 over 12. And that would be $150. Now the asset has a new balance. Remember, the accumulated depreciation balance were $4,650. We're going to add the $150, so it's going to be $4,800. So to discard the equipment, then we are going to debit the accumulated depreciation for the equipment by its full value, $4,800. And we're going to credit the equipment for its original cost, which is $6,000. Notice this asset or this equipment was not fully depreciated. In other words, we still had some balance for the equipment value. It still had some book value, yet we just discarded it. So the book value would be recorded as a loss. So since the plug-in value here, which is $1,200, the difference between the $6,000 and the total value of accumulated depreciation is $1,200, we're going to debit that, and we call that loss on disposal of the equipment. So loss on disposal of equipment, if the plug-in value is on a debit, and of course that's expected because we didn't receive any cash or anything like that, so it's going to be a loss. and this loss is going to be always on the debit side. So the loss of the $1,200 is recorded because the balance of the accumulated depreciation account, which is $4,800, is less than the balance of the equipment account, which is the $6,000, the original value. So losses on the discarding of fixed assets will be reported on the income statement. Now let's assume a different scenario. We have an old fixed asset and we decided to sell it. And selling is different because when you discard something, you don't have a choice. It's either you break even or you have a loss. But when you sell it, you could either break even, you could have a loss if you sold it for a price below its book value, or you can have a gain if you sold it for a price that's higher than its book value. So that's why selling a fixed asset would give us different scenarios. We have like three scenarios or three possibilities, so to speak. So the entry to record the sale of a fixed asset is similar to the entry for discarding an asset. The only difference is that the receipt of cash is also recorded. So we should expect that cash is going to be involved. And of course, here we're going to be selling an asset. We expect to be collecting cash. So the cash would be always recorded on the debit side. So as I said before, if the selling price is more than the book value of the asset, a gain will be recorded. And gains are always recorded on the credit side, very similar to revenues. If the selling price is less than the book value, then we have a loss that should be recorded, and all losses should be recorded on the debit side. So we'll see how this works. Assume that equipment is purchased at a cost of $10,000 with no estimated residual value, and it's depreciated at a straight line rate of 10%. The equipment is sold for cash on October 12th, so we'll assume, since it's before October 15th, we'll assume that this is October 1st, okay, or September 30th. So in other words, we only use it for 9 months during this year. So the equipment is sold for cash on October 12th of the 8th year of its use. So it's been used for 7 years, and in the 8th year, it has been only used for 9 months out of the 12. The balance of the accumulated depreciation account as of the preceding December 31st is $7,000. The entry to update the depreciation for the 9 months would be as follows. Again, we take the $10,000, which is the original value of the equipment, multiplied by 10%, which is the depreciation rate, straight line rate, multiplied by 9 over 12. And again, the 9 out of 12 here is assuming that we use this equipment until September 30th. Why did we do that? Because it's October 12th. If it was October 17, we'll assume that the month of October was used and we'll multiply it by 10 over 12. But in this case, since it didn't reach the mid of October, we'll just assume it's October 1st or September 30th. So after the current depreciation is recorded, the book value of the asset is going to be $2,250, which is the $10,000 original cost minus the accumulated depreciation, which was the $7,000 plus the $750 that we just calculated. And again, remember, on October 12th, we have to update our depreciation with this journal entry where we debit depreciation expense and we credit the accumulated depreciation. The entry to record the sale of the asset would be as follows. So assume that we sold it based on its book value. In other words, in an amount equal to its book value. So in this case, we're going to credit the equipment for $10,000 to get rid of the equipment, which normally has a debit balance. We're going to debit the accumulated depreciation for the equipment, which again normally has a credit balance. We want to get rid of it, so we debit it for the value that we already updated, which is $7,750. And the difference here is the amount of cash, $2,250. There's no gain or no loss because this is a case where we sold the equipment at an amount equal to its book value. What if we sold it at an amount less than its book value? So remember, the book value is $2,250. We sold it only for $1,000, so we have a loss of $1,250. So we're going to credit the equipment for $10,000. We are going to debit accumulated depreciation. These go hand in hand. You do these together. Then you debit the amount of cash you collected from selling this fixed asset for $1,000. Now let's add the debit side. It's $8,750, and on the credit we have $10,000. So we need to plug in a value here which is equal to $1,250. What that or what these 100,250 would be, this is a loss on the sale of equipment. So since the plug-in amount is on the debit side, this has to be recorded as a loss. So remember, we have to make sure that debit and credit balance. If they don't, then we see how much is the plug-in amount and whether it's debit or credit. If it's on the debit, it's a loss. If it goes on the credit, then we have a gain. And we'll see the next case here. So in this case here, let's assume that we had a gain, or we sold it for $2,800. So in this case, we had a gain of $550 because the book value is $2,250. So the process is exactly the same again. We credit the equipment for $10,000. We debit the accumulated depreciation for $7,750, and then we debit the cash, which is the amount of cash that we collected, $2,800. We add the debit, and in this case it's going to be $10,550. On the credit, we only have equipment for $10,000, so we have to balance the journal entry. We credit $550, and that would be the gain on sale of equipment. Since the plug-in amount is on the credit, it has to be a gain. So please remember that the amount of gain or loss is the last thing that we decide on. Of course, we can figure it out by comparing how much cash we collected compared to the book value of that fixed asset or that sold fixed asset. But even if we didn't do the math ahead of our journal entry, through the journal entry we can figure out whether it's a gain or loss. But always remember, gains are credit, losses are debit. So let me stop here. In the next video we'll continue discussing this chapter.